So how should you pick a stock? Well, the two things that I look for if I'm going to buy a stock, and which I rarely do because I do usually stay with index funds, usually ETFs. But if you are going to look for a stock, one thing I always look for I look for a stock that has an incredible ability to grow substantially. There aren't a lot of barriers to it growing, but at the same time, you want to make sure that its competitors are not really able to grow so massively either. As an example, I recently made a video about why MasterCard and Visa are great stocks. One thing that are great about those is that it doesn't really cost MasterCard and Visa to expand into other markets that much. They already have the infrastructure there, so if new merchants are using their payment systems, that's great for them, but it doesn't necessarily cost them more. Now let's look at another stock that I owned in the past. Unfortunately, it was El Pollo Loco. Think about how much work it is to create an El Pollo Loco restaurant in order to grow your revenue. That's enormously costly, and it's not necessarily true that you will even make a profit on your next store. So that's actually an issue of scale. You can't really scale up as much on a store like El Pollo Loco, and plus the margins are not as good for like a El Pollo Loco restaurant versus MasterCard and Visa. That's just not the case. It's a lot harder to expand profitably for an El Pollo Loco restaurant. That's another reason why the stock of El Pollo Loco has not done very well over time, especially because the costs have risen far above what the revenue can be. So that's something to really keep in mind. Return on equity, the amount of margin, in other words, a profit margin of a business is really important. But I think a lot of people, they sometimes look into the PE ratio, and they oftentimes think, oh, that stock is too expensive, I don't want to buy that because the PE is above 20 or it's 30. But the truth is, the most successful stocks in history, oftentimes their PE would be very high. In fact, some of the stocks that have extremely low PE, it's like a warning sign that investors have just a very negative view about what is likely to be the case for the future. As an example, Carnival Cruise, I think they have like PE of 3. And as an example, that's a sign that investors don't think they're going to make hardly any money. So why would you buy that? That's just it would not be a very wise thing to do. So you should ignore a lot of the common wisdom, and the common wisdom is oftentimes promoted by people who don't make money in the stock market. And you definitely don't want to listen to people who don't know what they're talking about, because people like journalists, they don't make money in the stock market. They don't know how to actually earn a lot of wealth. And so it's really important to ignore them, because even though the majority will listen to them and think their information is useful, it really isn't. So the other thing is, it's also important to realize that stocks that are really cheap or declining pretty substantially, like I noticed a lot of stocks that people have been promoting, like marijuana stocks and things like that, a lot of them look like they're going over the cliff, and people don't seem to realize that that was kind of a fad. These kind of stocks, they're not really sustainable, they're not moving up for whatever reason. It doesn't matter if you think you're right, the stock market will pretty much tell you if you're wrong. And if it looks like things are not going well, you have to cut your losses. So you have to, if you're going to be buying the individual stocks, you have to come to the conclusion that you could be wrong. And a lot of people don't really have that. They don't have the ability to admit that they might be wrong. It's a hard thing to take a loss, because it's real money. You lost money, and you don't want to purposely take a loss. But actually, the most successful investors in history, they have taken the losses, because that's the only way to get rid of that and focus on something that will make you money. Staking around on a stock that's going down, it just doesn't work out very well for people. I know so many stocks that have gone down 96%, 99%. Some of them go out of business. It really is not worth it. And it's bad for your health too, because if you're worried about the stock and you're getting angry, it really isn't helping. So some people have very strict sell rules. Like some people, if they buy it really well, they're buying it and their losses, their stop loss is like 2 to 3%. That's all they're willing to take, and they're gone. Whereas some traditional ways of looking at it would be to have like a 7 to 8% stop loss. I mean, that's really up to the individual in terms of how much they're willing to risk. So I personally prefer in the 5% range or less, but sometimes that's not possible. So one of the most important things is to have an exit strategy when you're buying stocks, because they can be dangerous. Oftentimes people are not really thinking nearly enough about what's going on, and you have to also consider even selling your stock before earnings are reported, because oftentimes it's called earnings roulette. When a stock reports earnings, it can go up substantially or it can go down substantially, and that's precisely because there's new information that's coming about, and it's oftentimes it's a new information hitting the market and people reacting to it very strongly. So if you don't want a wild swing, you could sell part of your position, or you could sell all of it. It just depends on what you want to handle. So that's how I view individual stocks, and I hope to look into this again in another future video. Feel free to leave your questions or comments in the comments below, and I'll take a look at them and respond to everybody. And be sure to subscribe and hit the like button. See you in the next video.